Hey guys, Whitney here. Thanks so much for joining us today. I'm just going to give everybody a minute to file in the room. Hopefully you guys had a fantastic 4th of July holiday weekend. I know mine was enjoyable. I actually got to spend quite a bit of time out with the team. Well, I shouldn't say quite a bit of time. I was out with the team viewing from afar the conference or MFIN conference. But if you guys didn't get a chance to attend this year, be on the lookout because we're going to do another in-person event here next June 12th through 14th. So make sure to mark your calendars. Ed, correct me if I'm wrong. It's in Charlotte again, correct?
I believe so, yes.
Awesome, guys. It was such an amazing event. We got to hang out with Shaquille O'Neal, Barbara Corcoran, Jocko Willink. Anyways, it was an amazing event. If you guys, like I said, go ahead and mark that down on your calendar, June 12th through 14th. And I think we have a quorum here. So I'm going to go ahead and kick us off and get started. All right. I lost my questions. Hold on, guys. All right. So just to do a formal introduction is welcome to the Passive Investing Made Simple show. I am Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And for you, those of you here, this is a live show. So we are going to dive deep into various topics related to passive investing to help you, put together a wealth of knowledge, but also put it to use in, so you can confidently go into your first or next investment. And if you haven't already done so, make sure to go to PassiveInvestingWithWhitney.com for future masterclass sessions and to check out our open deals. And if you'd like to, schedule time with me so we can talk one-on-one. Now, to kick off today's show, I wanted to bring in a very, very special guest, and that is Ed Gilmer, Director of Capital Markets here at PassiveInvesting.com. We are going to talk about all things lending today. I know the lending environment has been shifting very quickly. I know conversations I'm having with investors, they've got tons of questions, and I was like, you know what? I'm going to bring in the expert to talk about this. So Ed, go ahead and take a moment and introduce yourself and your role here at PassiveInvesting.com.
Sure. Thanks, Whitney. My name is Ed Gilmer. I handle all our lender relationships, find loans for all the asset classes, manage our existing loans, and develop relationships with new lenders to help get us the best terms on our deals.
Awesome. Excellent.
I live in Merle's, South Carolina, I think down here by the coast, with my wife and our son, and we have 2 on the way and 2 dogs. So
you guys are about to be outnumbered, aren't you?
We are.
Oh, goodness. Well, guys, I know, again, like I said, I have a lot of conversations with investors, and just with everything shifting with the Federal Reserve moving up the rate, it's impacting the lending environment, and we know that these impacts have been coming down actually for months. It's not new. And I just wanted to just kind of, again, do an episode where we can kind of explore the topic, but I want to start at the beginning, right? Just kind of give our listeners a base. And that is, like, could you recap the various types of lending that could be used in the syndication that investors should know about?
Sure. It depends on the size of the deal. If you're doing a small deal, you could probably go with a bank or a regional bank. Most of our PassiveInvesting.com deals are much larger. We go with private lenders. Our last couple of loans were in the $50 to $70 million range. There's a lot of different ins and outs with those than there is, a $5 or $10 million loan. We also have different types of loan with different asset classes. With the self-storage, those are a little bit smaller deals. There's some bank money there, some life company money, some debt funds, larger institutional funds available. And we're also doing a lot of car wash loans. In the last couple of months, we're rolling up a lot of those. And those are even smaller regional bank type loans.
Okay, had myself on mute there, guys. I'm back. I know several people are starting to raise their hand for questions. Make sure you find your Q&A box and drop in your questions there. That'll help me stay organized and make sure that we get all your questions answered. But so what I heard you say, and let's kind of start back, at the beginning. There's 2 different types of loans. There's private loans and government-sponsored loans. What can you tell us kind of like the difference between those 2 type of loans, and then we can kind of go down and break through break into the different asset classes and
Sure.
what loans are more appropriate for each asset class?
Sure. From a high level, the government service type loans or the Fannie Mae, Freddie Mac type loans, those we have a couple of those on our books, and we look at those. We look at all loans on every deal. So let me start with that. But those tend to have longer prepayment penalties. With those, you're stuck with them for 7 or 10 years or longer before getting out without a prepayment penalty, and it kind of limits your options on deals. And private loans that's where probably 90% of deals happen for us and for everybody. There's a whole world there between debt funds, life insurance companies lending money, private equity firms, family offices lending money. There's banks all fall under that private umbrella.
And are there, you mentioned the prepayment penalty on the government sponsored entity loans, but, are there additional pros and cons between, which type of category you use?
Sure, absolutely. Time frame. On some of the government loans, the HUD loan, I forgot to mention that one. So you have Fannie Mae, Freddie Mac, HUD loan. Those things take 7 to 9 months to do. So if we're buying a deal, we have 45, 60, 90 days to buy it. That loan doesn't work. That might be a better loan for like a refinance when you have time to work through the process. There's rates. The government loans a lot of times have better rates, but like I said, they're not always a good fit for each deal. And in the last 6 to 12 months, they've only wanted to loan about 45 to 50% loan to value on multifamily, which means a sponsor would have to raise a lot more money. And the numbers don't work for anybody. So we kind of look at each deal individually and look at all our options.
Okay.
Find the best fit.
All right. So, just kind of, being in the space as long as I have, we're looking to close the deal. And like you said, in that 45-day window, we need to get access to better terms with the different type of loans. So it sounds like private might be a little bit more advantageous, especially on the multifamily side. So
Sure.
On the different types of debt, you mentioned that, with the different asset classes, we're using different types of debt. Could you break that down again and kind of maybe help the listener understand like why we're using that type of debt on that particular asset?
Sure. I could speak for passiveinvesting.com as well as a lot of multifamily buyers the last couple of years. The best type of loan has been floating rate loans, interest only. They're just priced so low, with rates being so low historically until the last few months. That was the best fit. And now with rates going up, we're starting to look at more fixed rate deals, just for some guarantee on the rate on the high end there. With the fixed rates, you put a little more down up front. You get 3, 5, 7 year term. With the car wash, we're doing a lot of car washes recently on a large scale, and those have more traditional commercial terms. A 5-year balloon based on a 20-year amortization period. You're paying from day one. You're paying principal and interest. Whereas on a lot of the multifamily, they're all interest only for a period of time. With the self-storage, it's a mix. We look for interest only for the first couple of years to get those stabilized, and then they roll into an amortizing or paying down type loan. We start paying part of the principal.
Ooh, so we can do that with all in one loan, or does that require a refinance?
One loan. So a lot of times those will be like a 2-1-1 or a 3-1-1, meaning 2 or 3 years with interest only, and then each additional year is amortizing, or you can get 1 year interest only. It depends on the deal and how stabilized it is and how far out they think they'll be before they reach the stabilization period. Banks want you to pay principal day one. We want to pay interest forever, no principal. So we got to meet in the middle on deals.
Well, the bank wants, security in their position on the deal for sure, or the lender. So how does an investor know what type of debt is being used in a particular deal?
I think our marketing folks put it out on the offering randoms. They put the kind of the ballpark terms we're looking at on those deals. On some of our current offering, we're looking at a fixed rate financing on that. It's a better fit given the market where we are. They're always welcome to ask. I get questions from the investor relations team all the time about debt, so happy to answer those however I can.
Mm-hmm. And so if there's a listener here that is not working with an operator that's being upfront on the different types of lending terms, or just didn't put that into the offering memorandum for whatever reason, what are some questions they can ask of the operator to kind of get at
Sure. A great question. If somebody's not being upfront with you with that, that scares me. That could mean they don't have the best loan. They could have a very high rate of interest. That could mean more of the profit of the deal going to a lender than to the investor. That's where my job comes into play, is trying to find the best deal, the best rate, and saving everybody money. So we can afford to take more of our proceeds and spread them around versus just paying a bank. So we have an extensive network of lenders to work with, and debt brokers as well, which they kind of spread the net a little wider and work on a lot of the contacts and bring the rates down as well. So if somebody's not sharing that information, that's a red flag for me.
And then, like, are there particular questions they could ask the operator to kind of dig in?
The terms, the structure. I guess a question I never get asked is, how did you find this lender? How did you know? Was a lot of our deals, our debt brokers will send us, 5 or 6, 8 or 10 options. We'll kind of narrow them down and pit the last 2 or 3 against each other and make them get the best offer for us. But if a sponsor is just calling one lender, one broker, and getting the first deal that comes across the table, or maybe if they're not that experienced of the sponsor, they're not getting the best terms, the best deals. That's where size comes into play. A lot of our lenders we have multiple deals with. They know we perform, they know we pay, and they tend to work with us and give us better terms next time.
Okay, so again, a different part of the real estate business is still dependent on relationships and performance.
That's all it is.
Where do you see capital markets going? You break out your crystal ball. Like, where are we today? What does this really look like? And then where do you see us going?
Loaded question. My personal opinion, I'm hoping that we're going to kind of settle out in the last half of the year. Inflation will slow down. The Fed will slow down raising the interest rate, which will in turn slow down the pace that our loan rates go up, and everybody's cost of capital goes up. So I'm hoping for minimal increases the rest of the year. I think realistically another 50 to 100 basis points is what I expect. And that's based on a lot of what I read. That's not just my opinion. So if we end up there and inflation kind of cools or slows down, I'm hopeful we can avoid a big correction, or the R word. So
the R word being recession. Taking a guess at that.
It is. Yeah.
And for people who are, don't really understand the lending world, can you explain what a basis point is, or maybe equate that to a different thing that they might know?
So the Fed funds rate is a rate at which banks lend each other money, or the government lends money to banks, and that trickle down effect affects, your interest rate on houses, your savings rates, your rate you pay on cars, and obviously our rate we pay on commercial debt too. Is almost a 1-for-1, very, very close.
Okay. So, and then whenever you say there's a 50, you're thinking or hoping that there's only going to be like an additional 50 basis points or 100 basis points bump. Does that, I'm going to take a stab, it equates to either a 0.5% or a 1% increase in rate.
Sure. Yeah, sorry. Yeah, 0.5% to 1% increase. We've already had, I believe, 2 or 3 rate increases this year of 50 or 75 basis points, which is significantly more and faster than any time in history. So
and
the rates have shot up.
Yeah, and the comment came in from a listener is that if a recession is declared, that what power does the Fed have to kind of reverse course?
They have the rate thing, they can lower rates, but they also would start buying back, or the amount of loans that they buy each month directly correlates to the markets. A lot of the loans get sold off and then funded and kind of guaranteed by the Feds. It's a mess, but they've slowed in the last 6 months the rate at which they're buying loans, and then also cranking up the interest rate is kind of pinch the market a little bit. So,
and so I guess, whenever we're talking about, stoking, the economy, what we've seen with COVID at least the early parts of COVID and in the 2008 recession, is that the Fed actually reversed course, and to avoid some sort of like deep recession or even a depression, they started to lower
Sure.
rates. Do you see that coming on the horizon at all?
Probably not in the near future, as much as I would like it. I don't think so. They're obviously incredibly smart people there. Love them or hate them, they know more than I do, more than you do, more than we all do. So um, I think they may adjust the rate at which they continue the rises, the rate increases. But if they were to immediately cut rates, that's like a terrible sign. That'd be things are just going way wrong. So they predict and kind of see where things are going with the markets, and they kind of adjust their direction each month or eight times a year. So hopefully they're not too far off.
All right, another question came in is, do you typically secure lender loan terms on each investment prior to closing, or do you announce a new investment opportunity while you're still shopping?
There's two different questions there. So the first one, secured terms before closing, you couldn't get a loan, you couldn't close unless you're closing in cash and then refining, which and once we announce terms in the OM, we have a pretty good ballpark of where we'll be. We either already have the debt matrix from the lenders with the options. There's that. And also I could tell you any day kind of where we'll be rate wise in the ballpark. And sometimes we have those locked down before the OM, sometimes we don't, but we at least have a very good idea of where rates will be with that particular investment.
Oh, awesome. Well, I'm so thankful that somebody is taking the time and the care and has the knowledge and expertise to manage that. I know for me, my own personal assets, like trying to figure out where the rates are at any point in time so you can make a qualified offer is a little dizzying. So
it's a lot. I mean, I got a sheet last week with 6 different spreads on there. We're working through that. And, one was like 0.13% interest difference. And this one has got a higher origination fee and longer term and shorter term. You got to kind of balance all these terms and kind of find what the best fit is for you. And then squeeze the lender as much as you can. So,
that's a great, let's explore that for a minute, because, I think, at least for me, and not only for myself, but in conversations that I have with investors, they're really focused on the interest rate. But there's a lot of other things that go into that package. And we've touched on prepayment penalties a little bit, especially the government-sponsored entity loans. But what are all those kind of like nuances when it comes to lending on these different deals that passive investing or any operator would be looking to negotiate?
It's similar to, I'm sure most people here have or know more about mortgages than commercial lending, but when you're buying a house, you don't look at just the rate. If you do, you do look at more than that. You look at the origination fees, you look at, how long is the loan. So on the commercial side with us, we look at, and a lot of these have exit fees or minimum interest. Is it 18 months? Is it 24 months? Or they have like I said, a prepay for, is it 1 year? Is it 3 years, 5 years? We have to balance that. We look at, is it interest only for 2 years or 3 years? And then is it changed for a year after that? And there's never one obvious answer. You got to kind of pick through them, do some calculations, do some thinking, and then go back to and beat them up a little more on a couple different buttons, be it rate, fees, term. The loan to value is a huge one too. This one's given us 70.01% LTV, and this one's given us 69, and this one's given us 72% LTV. And the higher LTV is not always the best deal. So we got to balance all those factors.
So if somebody wants to understand more about capital markets and what resources, or I guess what the question is, what resources are available to them?
I would read as much as you can, stay up to date on businesses, globally, nationally, just digest a lot of the articles from economists and talk to some lender connections you have. You're welcome to message our investor relations team. I can answer any questions you have there. Just listen, reading and listening.
Awesome. Well, and if there's a big takeaway that you want listeners to have from this episode, what would it be?
That someone, or myself in our case, actively managing our lender relationships and our loans, our existing loans and our new loans and our new deals brings value to the investor, opposed to just having call in one person, I'll let them take care of it, a third party. We're obviously vested interest in the company and making sure that we get the best terms we can on every deal. And even when it comes time to refinance deals and finding the right people, the right relationships, I'm a big relationship person. I believe that that's most of what my job is people, connecting people and finding the best opportunities for us. So that's what I think I bring to the team with this role.
Awesome. Well, guys, I know there's other questions that are coming in, and if you're joining here live, we are going to answer those in the after party, so don't go anywhere. But I just want to say thank you so much for joining me today. You spending your number one resource, which is your time, to not only invest, spend it with us, but also invest in yourself. If you guys want to get a sneak peek on any of our additional masterclasses that we have, as well as our open deals, make sure to check out passiveinvestingwithwhitney.com. Ed, thank you for joining us today. This has been an amazing, just like a little bit of a primer and demystifying what it is that we're actually doing. And then, again, additional value that we bring to the investor by helping them manage all these different relationships.
Sure. Thank you for having me.
Yeah.